Welcome to Iron Financial. I'm your lead analyst. Today, we are putting NXP Semiconductors, ticker NXPI, on the anvil. You see, after a brutal, punishing year, this stock is starting to show some serious signs of life. But our job here isn't to chase momentum. Our job is to determine if what we're seeing is a solid foundation being laid for real long-term growth, or if there are critical stress fractures just hiding beneath the surface, ready to crack under pressure. We're here to hammer out the facts and stress test the entire structure. Let's get to work. So let's cut right to the core of it, shall we? The one question that every single serious investor needs to be asking about NXP right now is this. Are we looking at a genuine structural turnaround that's built on a bedrock of concrete fundamentals? Or is this just another wave of market hype, a short-term rally driven by sentiment and nothing more? Is the market building a skyscraper on a foundation of sand, or is there a bedrock of real, tangible performance here that can actually support a much, much higher valuation down the road? That's the conflict, that's the tension we are going to resolve today. And to get to the bottom of this, you're going to hear two distinct perspectives. I'm the lead analyst. My world revolves around the hard data, the revenue reports, the margin compression, the debt covenants. My job is to put the numbers under extreme pressure and see if they buckle. And joining me is our market skeptic. Now, he's here to represent you, the investor, and his sole purpose is to cut through the corporate jargon and ask the questions you're thinking. Is this story for real, or is it an elaborate trap being set for your capital? Together, we're going to build the complete blueprint. Here's our plan of attack. First, we're going to define the battlefield at NXP's inflection point. Then, we'll take a hard look at the leadership change, a new architect at the helm. After that, it's time for the heavy lifting, stress testing the financials. From there, we'll pull back and look at Wall Street's blueprint to gauge the consensus view. Then we'll analyze their long-term strategy in building for tomorrow. And finally, we'll smelt it all down into the iron financial verdict. Okay, first up, NXP's inflection point. Let's set the stage. After a really rocky start to 2025, something changed. The company's fortunes and, more importantly, its stock price started to pivot. The market narrative suddenly shifted, and it started to sound like a comeback story. But for us, the critical question isn't just that things got better, it's why. Are we just seeing a temporary bounce, a dead cat bounce off an oversold condition? Or is this the real beginning of a sustained multi-year recovery? This is where it all begins. Whoa, hold on a second. Let's pump the brakes on that term right there, cyclical recovery. That's one of those Wall Street buzzwords that gets tossed around to make a simple bounce sound way more intelligent than it is. So let's be crystal clear about what we're talking about. A cyclical recovery is just when a beaten-down industry, like cars, or in this case semiconductors, simply stops getting worse. It bounces off the bottom because it can't go any lower. It's often temporary. But a structural recovery, that's a different beast entirely. That means the company itself has fundamentally changed. It's gotten more efficient, it's stolen market share, or it's developed game-changing technology. It means a permanently higher floor for the business. So I have to ask, which is it for NXP? Are they just riding a temporary industry wave, or is there real tangible strength being forged inside the company itself? Because let's face it, one builds a short-term trade, the other builds a core portfolio holding. I need to know if this is a real foundation or just a fresh coat of paint on a crumbling wall. And that is exactly the right question to ask. It's the perfect distinction to make. And believe me, we are going to get to the numbers that answer it. But before we dig into the balance sheet, we have to address a huge change that often comes before a real structural turnaround: new leadership. You see, you can't fundamentally change a company's path without changing the person steering the ship. When you hire a new architect, you have to scrutinize their blueprint. And maybe even more importantly, you have to see how much the board is willing to pay to see that blueprint become a reality. For NXP, this is a massive piece of the puzzle. Let's look at the facts. So here's the bottom line. On October 28, 2025, the old CEO, Kurt Sievers, retired. The board then unanimously appointed Rafael Sotomayor as the new president and CEO. Now listen, this was not some minor reshuffling of the deck chairs. This was a decisive, clean break and a change in command. Sotomayor is not a caretaker CEO. He's been brought in specifically to execute this recovery and to forge the company's future. The entire weight of this new strategic direction now rests squarely on his shoulders. Okay, fine, a new CEO, I get it. It can absolutely be a catalyst for change. But a press release is just words on a page. Talk is cheap. Real conviction, the kind that matters to investors, is shown with cold, hard cash. So what's the price tag on this new architect? Did the board have to open up the vault and break the bank just to get their guy? I want to know exactly what this supposed turnaround is costing shareholders before a single new product is even shipped. Are they just throwing money at a potential fix? Or is this a smart, calculated investment in proven leadership? Show me the employment agreement.
And this slide answers that question head on. Look, this is not your standard run-of-the-mill executive package. This is a pay-for-performance mandate, plain and simple. Sotomayor's base salary is just over $1 million. That's pretty standard. But pay attention, look closer. His target annual bonus is a whopping 170% of that base. And the real story, the part that every investor needs to laser focus on, is that long-term incentive award, $10.5 million. But here's the absolute killer detail buried in the fine print. 70% of that long-term money, the vast majority of his potential payday, is in performance-based restricted stock units. That means he doesn't see a dime of it unless the company hits very specific, very difficult long-term performance goals. The board has literally handcuffed his personal financial success directly to the success of shareholders. This isn't just hiring a new guy. It's a massive, targeted investment designed to make sure he builds for the long haul, not just for a cheap quarterly pop.
All right, now we get to the real work. Leadership, narrative, that's all important context, but at Iron Financial, we build portfolios on one thing, the unshakable foundation of hard numbers. So it's time to stress test the financials. We're about to put NXP's claims of a big turnaround under intense pressure to see if they hold up. The story sounds good, sure, but do the numbers actually back it up? This is where we separate the market hype from the investment-grade reality. Let's start with the big one, the headline number from their fourth quarter 2025 results. Revenue clocked in at $3.34 billion. Now, on its own, that's a pretty solid number, but what really matters to us is that it blew past the midpoint of their own guidance. Let me put that in simple terms. They told the market what they were planning to do, and then they went out and did even better. That's the very first sign of strong operational control and solid execution. Whoa, 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 let's slow this train down. A single data point does not make a trend. It's not a foundation. $3.34 billion sounds big and impressive, but without any context, it's a completely meaningless number. Is that number growing or shrinking? How does it stack up against the last quarter? And way more importantly, how does it compare to this exact same time last year? You see, a single support beam doesn't make a building safe. I need to see the entire support structure. So give me the comparisons. Let's find out if this is real, sustainable growth or just a statistical blip. And this slide gives you that exact context. This is what real momentum looks like when you translate it into numbers. Compared to the third quarter of 2025, that's your sequential growth. Revenue is up 5%. That's solid, but the number that really confirms a structural turnaround is the year-over-year figure. Compared to the fourth quarter of the previous year, revenue is up a very strong 7%. You see, this isn't an anomaly, this is acceleration. When you see both sequential and annual growth happening at the same time, especially in a semiconductor market that's been choppy for a lot of companies, that tells you the positive momentum is real and it is building on itself. And look, it's not just about selling more stuff. Top-line revenue growth is great, but a company can grow its sales and still bleed money. So let's look at the bottom line. The earnings per share, or EPS, which is a key measure of profitability. The Wall Street analysts, the folks who get paid to model every move this company makes, they expected NXP to earn $3.16 per share. But as you can see from that taller bar on the right, NXP came in and reported $3.35. That is a 6% beat. So not only are they growing their sales, they are also managing their costs and their operations so efficiently that more of that money is dropping straight to the bottom line. That demonstrates discipline and powerful operational leverage. So the big question is, where is all this strength coming from? This breakdown right here is absolutely critical if you want to understand the entire investment thesis for NXP. Just look at that massive slice of the chart. Automotive. A staggering 56% of NXP's total revenue comes directly from the auto sector. That is almost $1.9 billion in a single quarter. This is their fortress. They are a dominant, deeply entrenched powerhouse in a high-growth, high-value market. But a fortress can also become a prison. That 56%, that's a massive concentration risk. The fortunes of this company are fundamentally welded to the health of the global automotive industry. If that cyclical market hits a speed bump or a downturn, NXP doesn't just catch a cold, it gets a severe case of pneumonia. Sure, industrial and IoT is a solid second place at 19%, but make no mistake about it. When you buy NXP stock, you are making a heavily leveraged bet on the future of cars. Okay, I'll give you that. The internal numbers, they show momentum. I can't argue with that. But here's the thing. We don't invest in a vacuum. What do the outside experts think? What is Wall Street's blueprint for this company moving forward? Are the professional analysts, the ones who cover this stock day in and day out, are they actually buying this turnaround story? Or do they see that same concentration risk we just talked about, and are they telling people to be careful? It's time to check the consensus. Well, the consensus is clear, and it is overwhelmingly positive. Out of 17 different analysts that cover the stock, you can see right there is not a single sell rating on it. Zero. A combined 82%, that's 14 out of 17 analysts, rate the stock as either a buy or a strong buy. That is a powerful consensus. They are telling their clients they believe NXP stock is going to outperform the broader market over the next 12 months. Only a tiny fraction are sitting on the fence with a hold. So Wall Street isn't just listening to the story. For the most part, they are endorsing it. And here's where they put a number on that optimism. The average price target from those 17 analysts comes out to $246, which implies about 6.5% of upside from where the stock is trading today. The more bullish analysts on the street see it going as high as $289, which would be a jump of over 25%. But let's apply some real pressure to this blueprint. An average upside of just 6.5% is hardly a compelling reason to take on the risk of owning a single stock. But more importantly, look at the spread between the high and low targets. You've got a low of 190 and a high of 289. That's a nearly $100 gap. That massive range is a proxy for uncertainty. It tells me that while the average opinion is positive, there's a huge amount of disagreement among the experts about how this story actually plays out. A dispersion that wide means there's a very real bear case that some people on the street are taking very seriously. And that uncertainty you pointed out is fair, and it's almost entirely tied to their ability to execute on the long-term strategy, which just happens to be our next focus. You see, a strong quarter is one thing, but a durable long-term investment is built on a company's ability to intelligently and strategically position itself for the future. So now, we're going to shift our focus to how NXP is building for tomorrow. We need to analyze the strategic moves they're making right now, the acquisitions, the divestitures, the huge capital projects, to see if they're actually constructing a durable path to sustainable growth. And this slide right here proves they are not just sitting on their hands. This is active, aggressive portfolio reshaping in action. They spent over $500 million on two very specific acquisitions: Aviva Links to beef up their leadership in high-speed in-car networking, and Kinara to get a critical foothold in energy-efficient AI processing at the edge. Think smarter cars and more intelligent factories. But at the same time, they're showing discipline. They sold off their non-core MEMS sensors business for almost $1 billion in cash to sharpen their focus. And then you have the elephant in the room, that joint venture with Vanguard to build a massive $7.8 billion fabrication plant in Singapore. This is not just routine maintenance. This is a fundamental re-architecting of the entire company's future. $7.8 billion. Let's just let that number sink in for a minute. That is a colossal project with an equally colossal amount of execution risk. What happens if there are construction delays or cost overruns? What if they can't get the production yields right when they flip the switch? A project of that size can become a concrete anchor that drags down the entire company's balance sheet for years and years if it goes sideways. And you are absolutely right to put a spotlight on that risk. It is the single biggest variable in the bear case. But let's see what a neutral third party, Taiwan Ratings Corp, had to say about it. They absolutely acknowledge the risk. They state that Vanguard, NXP's partner in this, will need to build a track record. That's the execution risk, stated plain and simple. But they also point out the key strength. Sizable long-term commitments reduces demand risk. You see, NXP and its partners didn't just decide to build this thing and hope customers would show up. They have already locked in customers to buy the initial capacity. So yes, there is immense execution risk in building the plant, but they have actively and intelligently worked to de-risk the demand side of the equation. It's a calculated, high-stakes gamble to secure their manufacturing future. All right, we've examined the new architect calling the shots. We've put the financials under the microscope, we've reviewed Wall Street's blueprint, and we've analyzed their massive long-term construction projects. We've gathered all the raw materials. Now it's time to forge all of this into a final structure and deliver the verdict. Is NXP a solid opportunity for your portfolio, or is it a trap just waiting to be sprung? Let's start with the bull case. The foundation here looks solid. The strong fourth quarter results, with that 7% year-over-year revenue growth and a 6% earnings beat, they confirm a real turnaround is underway. The company has a dominant, fortified position in the high-growth automotive market, which is undergoing a once-in-a-century semiconductor fuel transformation. You have a new, heavily invested CEO whose paycheck is directly tied to creating long-term shareholder value. And they're making smart, targeted acquisitions in future-proof areas like AI and in-car networking. The bulls see a very well-engineered structure. Now for the bear case, the potential cracks in the armor. Let's not forget that even with that strong Q4, the full-year revenue for 2025 was still down 3% from the year before. This recovery isn't fully baked. That dominant position in automotive, it's a double-edged sword that creates a dangerous over-reliance on a single, notoriously cyclical industry. We absolutely cannot overstate the massive execution risk on that $7.8 billion fab project in Singapore. It could be a game-changer, or it could be a balance sheet wrecker. And finally, while the overall analyst view is positive, the data shows that the number of strong buy ratings has been trending down over the last 6 months, from 8 down to 5. That tells me that some of the most enthusiastic bulls are starting to get a little more cautious.
So, here it is, the IR Financial final call. NXP has successfully hammered out the groundwork for a real turnaround. The recent numbers are strong. The new leadership is incentivized. The strategy is clear. But this structure is far from complete, and the heaviest, most difficult part of the construction is still ahead of them. The ultimate question for you, the investor, boils down to this. Do you trust the new architect, Rafael Sotomayor, to build upon this solid foundation and execute flawlessly on these incredibly ambitious plans? Or do you believe that the immense weight of that $7.8 billion Singapore fab, combined with the cyclical pressures of the auto market, will ultimately prove to be too much, causing the entire structure to fracture under the load? That is the decision you have to make for your portfolio.